Have you ever looked at the stock market hitting another all-time high and thought, this can't be a good time to invest, maybe we should wait until it drops? It's a natural feeling. After all, buying at the top sounds like the last thing anyone would want to do. But here's the surprising truth. History suggests that investing at all-time highs might not be nearly as risky as our emotions make it seem. In fact, it can often be a great time to invest. So today, let's dig deep into this question. Should we invest when the market is at all-time highs? When we hear that the market is at an all-time high, many of us instinctively feel nervous. It almost feels like standing on the edge of a cliff, like the only direction left is down. But think about it, the stock market has been hitting new highs regularly for over a century. Each of those highs was eventually followed by another one, and then another. If every all-time high really meant the peak, the market would have stopped climbing decades ago. The truth is, markets spend a lot of time near or at record levels. That's not unusual, it's what long-term growth looks like. Let's back this up with data. What actually happens after the market reaches an all-time high? Research shows the average return over the next year was about 10.3%, compared to just 8.6% if we invested at random. Since 1960, the market returned an average of 11.7% in the following 12 months. Looking at 3 years later, studies found average annual returns of 7.6% after highs, nearly the same as investing at other times, with some showing cumulative gains of around 10.6%. And even better, some results showed 3-year returns more than 10 percentage points higher than random entry points. Over 5 years, the average return after investing at a high was about 10.2%, with some studies showing these returns were over 7 percentage points better than random investing. And here's something striking. Since 1950, the market has made over 1,250 all-time highs, more than 16 per year on average. Despite that, corrections of 10% or more within the following year only happened about 9% of the time. And in all the 10-year periods that began at an all-time high since 1950, the market has never ended more than 10% lower. So why don't people trust this? Behavioral finance gives us the answer. Our brains hate losing money, so buying at the top feels dangerous. But here's the problem. Waiting for the perfect moment often means waiting forever. People sit on the sidelines as the market rises, then get scared when it finally dips, and still don't buy. To time the market successfully, we'd need to be right twice, once when we get out, and once when we get back in, and almost no one gets that right consistently. The biggest risk isn't buying at a high. The biggest risk is not investing at all. So, what's the solution? Consistency. Investing a fixed amount on a regular schedule, whether the market is high or low, takes emotions out of the equation. Sometimes we buy at higher prices, sometimes at lower prices, but over time it averages out. Think of it like planting seeds in a garden. We don't stop planting just because today's weather looks good or bad. We keep planting and the garden grows. Consistency also lets us tap into compounding. Every dollar invested has the chance to grow, and then that growth generates even more growth. The earlier we start and the more regularly we invest, the more powerful compounding becomes. When we wait for a better entry point, we aren't just missing short-term gains. We're taking away time from compounding. Of course, we should be honest. Markets do drop. They always have and they always will. Corrections, bear markets, downturns, these are part of the journey. But history also shows that every decline has eventually been followed by recovery and new highs. Not immediately, not painlessly, but consistently, over time. So the real question isn't, will the market drop? The real question is, will we stay invested long enough to benefit from the recovery? What if we try to wait it out? If the market keeps climbing, we miss out. If it drops, fear often keeps us frozen. And even if we do buy during a dip, we almost never buy at the exact bottom. Waiting for certainty usually means waiting forever. The alternative is discipline. Discipline means staying consistent, ignoring the noise, and trusting the process. All-time highs aren't unusual, they're milestones along the way. What matters is participating in the journey, not predicting the perfect moment. If you're finding this helpful, and you're enjoying the way we're breaking this down, go ahead and hit that like button. It really helps support the channel. And if you want to keep learning about how money, psychology, and long-term thinking all connect, make sure to subscribe so you don't miss future videos. Think of the market like climbing a mountain. Every new step higher is your all-time high. But you don't stop climbing just because you're higher than ever. You keep going because the summit is still ahead. The market is the same way. Each high is just another step in a much longer climb. Sometimes the path dips down, sometimes it flattens, but over the long run, the direction is upward. So should we invest when the market is at all-time highs? The evidence says yes. Because long-term success isn't about catching the exact right moment. It's about participation, patience, and consistency. History shows that 1, 3, and 5 years after new highs, the market has usually gone on to deliver strong returns. Psychology shows that timing the market is nearly impossible. And experience shows that consistency and compounding beat hesitation every time. We don't need to fear all-time highs, we need to embrace them as milestones on the journey. So now let's turn it over to you. How do you personally feel about investing at all-time highs? Do you find it exciting, scary, or somewhere in between? Let us know in the comments below. Thanks for watching, and until next time, stay consistent, stay patient, and keep moving forward.